Welcome to Yahoo Finance Live this Wednesday. I am Shauna Smith along with Dave Briggs and Julie Hyman. Now we are moments away from the Fed's decision on interest rates. Wall Street widely expecting a 25 basis point hike, although not everyone is buying in. You have Goldman Sachs, Wells Fargo, two of the names out there actually expecting a pause. Let's take a look at how stocks are trading ahead of this decision. You can see a bit of a mixed picture, although not too far from the flat line. You have the Dow off 76 points, S&P just below the flat line. The Nasdaq, though, Dave, holding on to gains of just about 0.2%.
Yeah, and remember those numbers, right? Because it is the most volatile next 2 hours you'll see probably all year when you chart it against past Fed days. It's just the volatility's off the charts. It'll be an interesting ride when we get the announcement and then when we get the words from Jerome Powell. I'm taking a look at bank stocks, of course, against the ongoing banking crisis. And First Republic always has been in focus for the last several days, fallen about 2%. PacWest really a rough day, but that's actually off the lows. It was down more than 10% earlier, raised about $1.5 billion, and said deposits had stabilized. Perhaps investors are a little more convinced because, again, it is off the lows a little bit. Western Alliance, you can see down about 4%. And KRE, that's the regional banking ETF, it's off about 2%, just to give you some context. And we'll certainly get some interesting words, Julie, from Jerome Powell on the ongoing bank crisis and the health of our banks.
Exactly. And what you're pointing out here really highlights why there's suspense around this Fed meeting, much more so than we have as of late. That's because you have price stability that the Fed has been really leaning into, fighting inflation. But now it has a financial stability that's not really part of its dual mandate, but it is something that the Fed is supposed to promote. Hasn't had to do that job for a little while here, certainly not during this tightening cycle. We're going to toss it over to Jen now. Jen Schomburger.
Rate hike. The Federal Reserve raising its benchmark interest rate by 0.25 percentage point to a new range of 4 3/4 and 5%, and saying that the banking system remains sound and resilient. Now, the Federal Reserve, in a hat tip to setting the stage for nearing the end of its rate hiking cycle, doing away with key language for ongoing increases in interest rates in its statement, saying instead that, quote, the committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation back to its 2% level over time. Now, Fed officials left unchanged how high they see raising rates ultimately, keeping that peak in the range of 5 to 5.25, which is what they had penciled in back in December. Though 7 officials see raising rates higher than that, one official seeing raising rates as high as 6%. No officials see rate cuts this year. Officials say they will closely monitor incoming information and assess the implications for monetary policy. Officials also continue to expect running off the balance sheet as planned. Now, on the banking system, officials said recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity and hiring, and that the effects of this is all, quote, uncertain. The Fed said that inflation risk remains elevated and that the central bank remains highly attentive to inflation risks, though they haven't really changed their forecast for inflation all that much, just seeing it tick up to 3.6% this year from 3.5% previously. On the employment front, officials say that job gains have picked up in recent months and are running at a, quote, robust pace. They see the unemployment rate ticking down to 4.5% from previously forecast 4.6%. GDP also expected to only eke out just 0.4% this year, down from 0.5% previously projected back in December. This decision was unanimous. Back to you.
All right, thanks so much, Jen. Taking a look at how markets are reacting to this, you have all three of the major averages now in the green. Nasdaq up just about 0.5%. The Dow up about 0.1%. And guys, when we dig into this release that we're just getting here from the Fed, 25 basis point, largely that was a consensus out there in the street in terms of what we are expecting, but they did do away with that ongoing rate increases language here within this statement. And they also reiterated the fact that the banks are sound, resilient, but those events to weigh on growth here in the future. So a lot of this was largely expected going into this announcement.
Absolutely. I think it would have been a real shock had they paused because, of course, what signal would that have sent that the banks weren't stable? And that probably would have incited a little panic. Of course, the markets certainly would have loved it and would have responded. But can we check on the markets and see what they're doing at the moment as a reaction to it? Not a ton of movement. You are seeing a little bit. Julie, your reaction to 0.4% GDP growth this year, pan back a little bit. And again, the language changing a little from prior statements.
Yeah, but at the same time saying that some further firming might be appropriate. So they are not saying this is it. That's not the message that they're projecting at all. Some firming might further be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. So 2% is not changing, right? They're not bringing up that inflation target, at least not at this point in time, which I think is important. The comments on the banking system are important. Surely Jay Powell is going to be asked more about that in the press conference. And then I'm trying to look at the dots here as well, which always take a little time to digest, right? But it looks like where we have the so-called median dot plot, if you will, where most of the dots are clustered, appears to be between 5 and 5.25 for the end of 2023. And that looks like that would be the terminal rate, if you will, the end of this hiking cycle. Between 5 and 5.25 is where we're looking at those dots before coming down through the course of 2024 and beyond.
Yeah, certainly. All right, we want to bring in Brian Belsky. He's here at the desk with us, BMO at Capital Markets, Chief Investment Strategist. Brian, just getting this decision from the Fed. Your reaction, first take.
Thank God. I'll say that. And Julie did a great job. By the way, I got the dream team here today. It's just amazing. I think Julie brought up a really great point about in terms of they're not saying they're not done, right? And I think this 25 basis point, in our view, we were hoping that they would do that from a messaging standpoint because of the banking system. Their job isn't done yet. They still have to push inflation lower, period. And I think it really sends a great message. I think actually if the Fed did nothing, I think that'd be bad news. And I think the market would have really taken that in the wrong direction.
Why? Why?
Because then the Fed would be saying, it's a great question, Briggsy. I think the market would have said, oh, what do you know what we don't know? And what aren't you saying, right? Is the economy really in trouble? Or now are we going to start tilting? So whereas they're staying on their function in terms of going after inflation. So the messaging, I think, is at least what we've heard so far. Again, we've been on these shows with you right after the Fed decision, and then it's really about the notes afterwards and what his press conference is. So this could be some conjecture. So let's see if his tone is less hawkish. I'm guessing it's going to be, but it's going to remain resolute with respect to what his plan is in terms of inflation.
It's been unanimous constantly under this regime. Don't you welcome some dissent among the Fed governors? I mean, there is zero.
You know, if you go back to the 80s, we had some dissension. In the 70s, we clearly had some dissension. You know, when Greenspan took over later on, during the latter part of his tenure, especially after the pivot, Dave, in 1995, this notion of dissension kind of went away. I would love to see some dissension. And it's funny how even a year ago, we had much more dovish people on the Fed. Now they're all kind of in unison. I think maybe there's been some communication that they've been talking about in terms of being more clear. But at the end of the day, I think they're doing a great job in terms of staying consistent in their story in terms of let's go after inflation.
And it seemed, we were just checking on the markets. We're not seeing that much of movement, maybe because people are waiting for the press conference. I'm sitting here trying to count dots on the dot plot. There's still, I was saying that it looks like the terminal rate, according to the majority of the committee, is between 5 and 5.25. There were 10 dots there in December. There are 10 dots there now. But do you think that the hiking cycle, the shape of it has changed at all, given what we've seen with the banks?
I think they're mutually exclusive events, and I think the Fed is telling you that as well.
Why are they mutually exclusive events? Is it because it's been contained and the Fed is said that's we've done our job, and the Treasury, the Fed, the FDIC has done its job, and now we don't need to worry about financial stability?
I think the notion and the common sense conclusion of we had a couple bad apples is coming to fruition. And it's kind of like the movie The Usual Suspects. Oh, by the way, yeah, they were the usual suspects that got in trouble. You know, for all intents and purposes, in our business in terms of investing, we have been questioning and wondering what was going to happen to the Swiss banking system since 2008. And when it was going to happen with respect to UBS and Credit Suisse, especially given all the money that's left Switzerland on the private wealth side and the change in the capital markets behavior in the last 15 years, Julie. So that isn't a big surprise, quite frankly. The bad apples that went down and have been kind of taken out, they got taken out for a reason. And I think the baby in the bathwater binary decision to sell all financials last week was a terrible decision. And we believe that financials are going to see the inverse of what happened in 2009, 10, 11. What happened in 2009, 10, 11 is investors moved away from the big banks. You're the bad guys. This time around, it's going to be the inverse. And I think that bodes well to our longer term theme in financials, which is scale. Okay, so the money center banks, the Canadian banks, the asset managers, and the brokers are in very, very, very good position. So I think there's going to be massive consolidation. It's not going to be one of these things. Now I'm hearing this, America's going to have 10 banks. And no. Slow down, okay? We're still capitalists. We still have a lot of public money in terms of these banks. And so, no, we're not going to get that concentrated, but the big banks are going to get bigger. And I wouldn't be surprised if you see a brokerage firm buy a regional bank as well. You're going to see something like that in the next few years.
Are you seeing any investment opportunity within those regional plays right now, or are you just waiting for the dust to settle?
I think, great question. I think you have to wait for the dust to settle, number one. I think it's going to be, as I kind of think of it fundamentally, I think it's going to be the smaller ones that are more concentrated where you actually can get your fingers in the assets and know exactly what they own, okay, small mid-cap banks, or the really big banks that have the balance sheet leverage and strength and multi-divisional assets. So it's small mid-cap banks that are more regional or more regionally associated with like real deposit money, like Julie Hyman's money, for instance, versus Mark Zuckerberg's money, for instance. Major difference. I think that's going to be.
Thanks a lot.
Well, I'm just.
It's okay.
So you mentioned usual suspects, and touche, by the way, it was poof, and Kaiser Soze is gone. Here, the writing leading up to this meeting was Jerome Powell is either going to focus on inflation or the banking crisis, with the conventional wisdom being that 25 could actually further worsen this banking crisis. Can it?
No, I don't think so, because the Treasury yields have already done that. The 2s and the 10s have already done that. And if you think about it, when you get a mortgage in the United States, it's based on the 10-year Treasury. That's number one. Number two, I think the terminal rate probably should be closer to 5.25 anyway. So if they would have done 50, that would have been amazing to me. Let's be done and then move on from here. Maybe that was the signal, but I think he wants to kind of play it close. And remember too that we don't have a meeting next month. So the next meeting is May. We have a lot of data between now and May, and I think he's hopeful that the semblance of the lagging part of inflation could actually begin to tip over.
We will see whether or not that happens. Brian Belsky, always great to have you in studio, especially on Fed Day.
Briggsy. I know that's your nickname, Dave.
Belsky and Briggsy, man, this could be a podcast. It'd be good.
Oh, I can feel it.
Belsky and Briggsy.
I can feel it.
We got to do that.
We have to.
There you go. That's
Hi,
on the
buddy.
docket too. All right, Brian, thanks so much. We want to continue this Fed reaction here, 25 basis point hike. For that, we want to bring in Sarah House, Wells Fargo senior economist, and Michael Kushma, Morgan Stanley Investment Management Chief Investment Officer, Broad Markets Fixed Income. Great to see both of you. Sarah, let me start with you, because Wells Fargo, the larger thinking there from you guys was that we were going to get a pause at this meeting. We got a 25 basis point hike. Was that a mistake?
No, I don't think it's really surprising. So we were saying it was a very close call and neither outcome would surprise us. But I think what we really saw here is that inflation remains the predominant concern among the FOMC. So you saw that with them hiking through this disinflationary event, the extent to which remains to be seen. But I think overall, the additional tightening we've seen in financial conditions does speed along the disinflation path ahead. But even through that hike, we saw the Fed raise its projections for core inflation, both this year and next. So I think we can certainly see that concern about inflation, which I think squares with their interest in going ahead with the hike today.
And Michael, your reaction to the 25 and to the language of additional policy firming ahead?
I think it's consistent with the idea that of late, prior to this financial market instability we've witnessed in the last couple of weeks, the data was running much hotter than expected, whether it's inflation data, labor market data, spending data, even housing data was getting better. So instead of the 450 basis points of rate hikes last year slowing things down, it looked like in the beginning of Q1 that the economy is accelerating. The Fed of Atlanta is now casting for Q1 GDP is running over 3%, probably going to come down. But things were going the opposite direction as desired. In some sense, a credit contraction, a credit or reduction in credit availability in the economy is something is probably important to have in order to hit the inflation target. So I think that with a month in between the next meeting, and reiterating their confidence that inflation is job number one, we can deal with financial market stability with other tools.
Sarah, let's dig into that inflation fighting question a little bit, because we've been talking to some economists, market watchers who have said, well, if you look at the last inflation report, a lot of it was shelter inflation. And, that's stuff that's starting to come down. So how much more are we going to have to see the Fed tighten from here, especially given the lag effect on inflation?
Yes, I don't think the Fed has much further to go from here. So we were looking for a terminal rate of 5.25, which the dot supported today. And I think why the Fed's still only looking at perhaps going just a little bit more is those lagged and cumulative effects which they've been stressing for a number of months and continue to stress today. And to very much extent, we saw some of those effects over the past few weeks. And so I think that the Fed realizes that the inflation data is somewhat backwards looking, but I do think they need to see a bit more downward momentum than we've seen over the past few months to feel confident that they can at least hold policy at an elevated level for some time and wait longer for inflation to move more discernibly lower.
Michael, do you think that this decision here from the Fed and the language that we've gotten so far ahead of this press conference here in just about 15 minutes, is it enough to kind of calm some of the jitters out there in the market that have been very apparent over the last couple of weeks, given the instability in some of the banks?
I think that it's important for them to reiterate once again that inflation is problem number one. The reason why we have high interest rates is because we have high inflation. The reason why we have banking sector issues, if it's because of high interest rates, it's because of high inflation. We can't get rid of high interest rates unless we get inflation down. So that is job number one. Obviously, we have to keep tabs on what's going on in the broader financial system to not cause an accident or a crisis, a true crisis down the road. But on the other hand, the economy has been very robust. There's no signs of issues in the money markets, general collateral, repo rates, OIS versus the other measures are all perfectly in range where they should be. So I don't think there's any sense of a crisis. There's pockets of problems around which can be dealt with by Treasury and the Fed, and that they need to focus on an inflation. And this is what they are doing.
Sarah, to Michael's point, and this is a point Brian Belsky was making too, and this is a point the Fed seems to be making too. It says the U.S. banking system is sound and resilient. We're going to get tighter credit conditions. The effect of these effects is uncertain, but it doesn't sound like they're alarmed. Is the banking crisis over? Was it really even a banking crisis in the first place?
Well, I think we need to be cautious in terms of whether the stress is truly and fully removed. But I think we've certainly seen some of that stress be relieved over the past couple of days, which I think gave the Fed the green light to go ahead and hike with today's interest rate. And I think when we overall step back and look at the banking sector, it is strong. If you look at the cash assets and the liquidity positions of the banking system, it's significantly higher than what we saw in 2008. Same thing with capital. And I think, when you look at the what we were expecting for this meeting, it really was just to take a breath, a true pause. And I think given the inflation backdrop, the further tightening is warranted. It just seems like, okay, it might be just a little bit too early. We want to make sure that the medicine takes before we saw that additional tightening today.
Michael, is the probability of a recession greater now than it was 3 weeks ago? And how do you expect, if he's posed that question, Mr. Powell will handle it?
I think it has to be at the margin because this issue has to affect the banking system as a whole. If they tighten up lending standards further, they reduce credit creation, maybe it's less profitable, the cost of funding, the balance sheet goes up. So I would think that the credit creation process in the months ahead is likely to be slower than what it was prior to the events of the last couple of weeks, which should help the process of disinflation. Remember, the Fed has probably been very surprised that the economy has been as strong as it has been, that inflation hasn't been fallen further, that growth hasn't fallen further, the unemployment rate hasn't really risen yet. It's probably surprised by all those things. So a reduction in credit growth over the next couple of months and quarters, it probably helps that process as long as it's orderly and it's not like stopping people from borrowing money who should be able to borrow money.
All right, got to leave it there. Michael Kushma, Sarah House. Appreciate that so much. Let's move on now to Andrew Levin, former Federal Reserve Board Special Advisor, Dartmouth College economics professor. Nice to see you on this day. As always, sir, your reaction, this is what you expected, but to the language as well, additional policy firming ahead and the 25.
Okay, great. So I would say two things. One, the markets are still more confident than the Fed about how quickly rates are going to come down. So the market expectation is that the funds rate's going to drop a percentage point, roughly a percentage point by the end of this year, and then another percentage point next year, where the Fed kind of sees the funds rate being still more or less above 5% at the end of this year and coming down a percentage point next year. So the whole path going forward over the next couple of years is different by about a percentage point. So we'll see, who turns out to be right.
Well, thus far, Andy, the Fed's been right? I mean, thus far, the Fed has been right? We've had this whole disconnect this year, and then slowly the market had come around to where the Fed was, and now that, and now is gapping below it once again. So the Fed has been right.
Okay, so that's the other point I was going to make. I think that the statement says that these recent developments are likely to tighten credit conditions. Well, we'll see. But the extent to which it turns out that this is fairly well contained and pretty limited, just a couple banks and the rest of the banking system stable and resilient, maybe there's not going to be much tightening in credit conditions. What you should realize is that GDP for the first quarter is estimated to be running at around 3%, which is strong. That's almost twice the sustainable path. The unemployment rate's very low. Jobless claims look great. No signs there. So I think the possibility investors should be aware of is that we get through a lot of the way into Q2 and the economy is still humming along. Inflation's still running at around 5%. That's where we were a few weeks ago before the banking stuff all came out. And the markets were starting to think, and Fed officials were starting to talk about, well, maybe the funds rate needs to go all the way up to 6. I think people should be really aware here. That's still on the table.
That's still on the table. Andy, when we talk about more the near term right now, the banking crisis, it sounds like you don't think this will add maybe stress to the banking system at all, right?
The problem, by the way, I'm old, so I remember 2008, these things always kind of come and go in waves. Okay, so imagine the what I just described starts to materialize, okay, over the next 3-4 months. That the economy is still strong, inflation's still resilient, nominal wage growth is still strong because workers want cost of living increases and firms are passing those through. That was the Fed's concern already a few months ago. In that scenario, and it becomes clear that the Fed will have to tighten further and that it's not going to be cutting rates anytime soon in the next year or two, the market rates are going to have to come up by a couple percentage points. Now you have to think about what's that going to do to all these mid-sized banks. The academic research suggests there's a couple hundred mid-sized banks that have balance sheets that are going to be really sensitive to changes in the rate outlook. So we could be back in May or June in a situation where there's starting to be real questions again about those banks and what more does the Treasury or the Fed or FDIC need to do. And then there will be another lull. So this is not played out yet. There's still a long way to go.
At the same time, do you think there has been a lot of hand-wringing over deposit flight to the larger banks, consolidation of power, and therefore potentially future risk down the road in the larger banks? Do you think that concern is overplayed? Even if some mid-sized banks get into trouble, there's a lot of banks out there in this country. Or do you think that is a legitimate concern?
I think this is why probably regardless of how this works itself out, probably won't hit the US macroeconomy very hard. Now, the Fed's projection is the unemployment rate's going to rise a percentage point by the end of this year. That's a lot. If that was happening, we'd expect to be starting to see signs of recession probably within the next several months. Again, right now, jobless claims look great. There's no hint at all that those kind of widespread layoffs are happening. And if we get through the next few weeks, and this seems like it's in the rearview mirror, the Fed will probably have to do more to slow the economy and to put some more downward pressure on inflation.
Do they need those job losses that you just referenced? And where do you see inflation by the end of the year?
Okay, well, one thing I watch very closely is the Cleveland Fed recently has started to publish a survey of consumers, a large weekly survey, 10,000 people a week that they're asking. That survey indicates that consumers generally expect inflation to be around 6% over the next 12 months. And it's come down a bit from around 7% to around 6%, but still 3 times higher than the Fed's inflation target. Now, the problem with that is that gets fed through into nominal wage growth, especially when you have a strong labor market. And then the higher nominal wage growth feeds through into prices. And so you have this wage price dynamic. And again, Fed officials were talking about this a lot a few weeks ago, starting to sound much more hawkish. And then partly because of that hawkishness led to these problems with some of these mid-sized banks.
All right, Andrew Levin, always great to have you on this day. Appreciate that very much. Let's take a look now at how markets are reacting to the news. Jared Blickery is here with that. My friend, what are we seeing?
All right, let's take a look at what happened in the Nasdaq. That is having the most outsized reaction, and it was to the upside here, but you can see it retraced most of that initial thrust, and now it's just kind of consolidating. By the way, this is what usually happens ahead of Jay Powell taking the lectern there. That's where the fireworks usually emerge. But let's take a look at the bond market, because we have the entire yield curve moving. First of all, 30-year T-bonds, they are down 3 basis points from yesterday, but here is the Fed announcement. You can see they are net up from that report. Let's move along their yield curve to the 10-year tenor. You can see that has erased the drop that it had initially. If you go to the 5-year, that's down 8 basis points, still in the process of working off some of that drop there. And then finally, the 13-week T-bill, which closely tracks that short end of the curve, that's down 4 basis points from yesterday, and we had a spike lower there as well. And then finally, here's the U.S. dollar index, one pretty big drop there, and not really coming back too much. So all in all, it looks like, at least temporarily, the market is interpreting this as a not too hawkish report. And finally, I want to close with Bitcoin. Bitcoin still elevated. We got a spike earlier today. Here's the FOMC Fed spike, and net up. By the way, 28,000. Haven't seen those prices in quite some time. I said that was the last one. Actually, do want to get to gold, because we saw that spike up as well. So gold, which has been on a little bit of a tear recently, that is up $20 to 1961 right there. So gold and Bitcoin saying not too hawkish here, but of course we got to wait for the fireworks.
We'll have to wait for the fireworks, which we'll get underway here in just under 5 minutes. Jared Blickery, thank you. And guys, when we take a look at the markets, I guess overall reaction, especially when you look at the major indices, yes, we did initially see those spikes or the dips, depending on what exactly you're looking at. But it seems as though the market's almost looking at this as not a non-event, but nothing huge, at least for right now. And a lot of that focus is going to be on the tone. We heard that from Belsky, from Powell here in just a minute, and exactly what he sees going forward could potentially really have big swings here for the market.
Yeah, fireworks is the way that Jared just described it. I think that's right. Nick Timiraos of the Wall Street Journal tweeting out that this was viewed as a dovish rise, right? And that seems to be the way that the market is reading it up till now. There were some questions beforehand. Even if they raise by a quarter point, will they forego the dot plot, for example? Will they not give projections? They didn't do that. So if there is going to be nuance here, there's a little bit of nuance in the statement, but if there's going to be more nuance, if there's going to be more commentary on the financial system, if there's going to be more commentary on how Jay Powell is thinking about the future path, That's going to have to come in the press conference. And that's really where people have questions.
And what do they want Powell to say today, right? Like I'm always watching the question they're pushing for him. I mean, he's always remained stable, but where are they going to try to push on Powell today? Presumably about the health of the banking sector. And how is he going to characterize that? Well, we know sound and resilient, but that's the angle that they'll continue to chip away at. It'll be interesting to see how he balances it.
It depends who they is, right? Like, I mean, besides the people in the room, right? There's so many different constituencies. And when it comes to the Federal Reserve, frequently they cannot win. In other words, there are so many critics from all sides. On the one hand, you have the critics who said, well, they kept quantitative easing too long. That laid the groundwork for the Silicon Valley Bank crisis that we saw it and caused all kinds of other dislocations in the system. Yes, there are some who are in that camp. In fact, I think that's a pretty large camp. There are some who say, okay, we're satisfied now with what the Fed has done. They made a mistake initially in viewing inflation as transitory. Then they came to catch up with it. But then when it comes to what they do now, you have a lot of discussion and divide in the market. You have people like Elon Musk who says, and Kathy Wood, who says they should stop now. There's already deflation
Elon
out
said
there.
Nomura was out
today.
there saying that we could actually see a cut.
Yeah, I mean, Nomura is definitely like the outlier on the street, but there is an unusual amount of dispersion in the forecast of what happens next. And, people are going to be poring over every little word that Jay Powell says.
Yeah, and I think a lot of it's just going to be about his confidence in the banking system. We heard it from Michael Cushman, Morgan Stanley earlier here in the program, saying that he needs to reiterate that inflation is the number one priority, is what they are most focused on right now, that they are comfortable with what is happening to an extent in the banking system in terms of the fact that they don't see a large risk here. They don't see contagion. I think that might be enough to shore up some of that risk or some of those jitters that have certainly been out there in the markets. Although you never know when you take a look at some of the wild swings that we have seen in a number of the regionals. It's not just PacWest, it's not just Western Alliance, it's a number of those other names in addition to First Republic there that have certainly seen their stock prices under a tremendous amount of pressure for the last couple of weeks.
PacWest still down about 10%, but circling back to something you said earlier, which was a common theme in all the writing leading up to this, is will Powell choose stability or inflation? Is it really an either or? Powell is choosing stability and inflation. I believe that's how he will characterize this hike today.
Yes, and if you look in this statement again, and if you listen to what our guests were saying, they don't view it as an either or either, because the Fed seems to be saying financial stability is not a huge risk right now.
Right.
Maybe I'm really curious how he's going to characterize it. Is it contained? I think he'll probably hedge. He's not going to say it's absolutely 100% unequivocally over. Whereas I think it's safe to say that inflation is still an issue here. I mean, if you look at the projections for inflation from the Fed that we got today, I guess we should listen to Jay Powell and see what he has to say about it.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, Inflation remains too high, and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SEP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming. Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So,
do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as vice chair for supervision. I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning, we sat down and said, let's do this. And he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is, that's just something that will have to come through softening demand, and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear to your last question. It's clear that we do need to strengthen supervision and regulation, and I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
And the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously. They were on this issue, but nonetheless, this still happened, and so that's really the nature of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive? Or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from, tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
Question, would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things. And we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I can follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
You know, if you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under Emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right, we have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
Absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless, what happened happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Let's go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well. So far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And I mean, there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
Mr. Mike, please.
Yes, sir. Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean. Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, particularly immediate attention. And I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question, and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. What can we do to make sure? But again, that's not for me to answer today.
So you have specific thoughts on that?
Well, I see. If I did, I wouldn't share them, because I really, this review is going on, and I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance.
Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it? And then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, so that's all I have to say. So, thank you. Thank you very much.
All right, that was Fed Chair Jay Powell here wrapping up his news conference. You can see stocks under pressure. This market check sponsored by Tasty Trade. All three of the major averages turning lower, as we heard from Fed Chair Jay Powell, really reiterating the Fed's commitment to getting inflation back to that 2% goal. He was rather hawkish, I think you can say, just in terms of saying that the Fed remains committed to that. The Fed will do what it takes in order to get inflation under control and get it back to that 2% level. Also, some interesting comments here, Dave, just on the banking sector, what we've seen play out at Silicon Valley Bank. He said the management there failed very badly. And then he was just failed badly, I should say. And then he was just also talking about maybe the possibility here to strengthen supervision and regulation down the road.
And saying they do welcome an independent investigation. And as has been the case since the beginning of this tightening cycle with Jerome Powell, he's remarkably consistent. And you can basically, it's fascinating to hear the questions and answer session, no question about that. But he is remarkably consistent from that opening statement, and that's really what you pull out. Sound and resilient is the banking system. That was one. Two, additional policy firming. That was the phrase we heard over and over again, and that was the one changed from additional rate hikes, and as well as the fact that it was unanimous. But you can try to push him, but he's not going to really move much from that original statement. What strikes me, Shauna, is that how much has changed in the last 3-4 weeks, given the SVB collapse and First Republic and instability in the banking crisis? Yet, from the words of Jerome Powell, not much has changed. The more things change, the more they stay the same. He has not moved from the 2% target. He has not moved much from their terminal rate. He has really been a rock, whether you like it or not, that's your call. He has not veered much at all, and it sounds like SVB didn't really change his perspective on what they need to do, nor of the economic conditions.
Yeah, at least up until this point. You said, of course, they want to see just more data. He's waiting for the results of the investigation. Like you said, he also did welcome an independent investigation. But I think the eventual maybe economic impact of the instability, or some of the turmoil, I should say, that we've seen in the banking sector, that has yet to be seen. And that's also something that Jay Powell reiterated a number of times throughout this press conference. He also said, in terms of his commitment here, Fed officials, he was saying, agree that rate cuts are not in our base case right now. We know the market going into this press conference, going into this FOMC decision, was anticipating the possibility of a rate cut later this year. Powell pushing back on that once again. But I think a lot of the questions, though, remain about the banking crisis. Yes, for right now, Powell was very confident in the fact that things were strong, things are solid, and nothing to be worried about. But then he did say that they will do whatever it takes in order to keep the banking system safe and sound, like you were saying. So he did a good job, I think, walking that very tight rope, really addressing the concerns that obviously we do have within the banking sector right now, but also remaining very committed to their goal and what it has been of bringing down inflation.
Price stability.
Yeah.
Remaining consistently anchored to their goal. Fed Chair Jerome Powell saying there was consideration for pausing rate hikes, but ultimately the Fed decided against it. Here's Chair Powell on why there was not a pause.
It was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words.
All right, for more reaction to the Fed decision, we're joined by Rebecca Felton, Riverfront Investment Group Senior Market Strategist. Nice to see you. So your reaction to the hike and to the tweak to the language, which emphasized additional policy firming ahead.
Well, thank you so much for having me, and not to sugarcoat it, but it was really nice to not have any surprises out of this release today, nor Chairman Powell's comments. We have been of the belief that they would have to continue to raise rates. Those inflation numbers are still way above where they want them to be, with that most recent core CPI coming in at 5.5%, and the PCE numbers also high. So it is going to take a while for them to get that price stability to a number where they want. And I believe when you think about what has happened in the recent weeks with these banks, very specifically, each of their problems have been very specific to them, and it doesn't suggest necessarily any type of contagion. So there will be more scrutiny, but we believe that everything we heard today was in line with expectations.
Rebecca, that new language in the statement, though, really does convey some of the uncertainty out there just in terms of the stress that we have seen within the banking sector. How are you looking at this from a market perspective and really the ability or the risk there that it could affect the economy down the line?
Well, you know, the implications down the road, aside from greater levels of scrutiny, particularly as we think about some of the regional banks, could be tighter lending conditions, which has impacts for growth, both for small businesses as well as consumers. And that would obviously have some impact on growth expectations going forward, which calls into question whether or not earnings estimates still have to come down further. We believe that estimates probably have already been revised enough. Obviously, we're headed into Q1 earnings season very quickly. It's hard to believe March is already over. So what we'll need to be paying attention to, obviously, are CapEx plans, hiring plans, and just some of those cost pressures that companies have been seeing, whether or not those are easing at all.
Leading up to this, a lot of discussion about whether or not Powell would focus on inflation and price stability or stabilizing this banking crisis. In your perspective, does the 25-point hike have any impact on the banking crisis as we now know it?
I believe it's too soon to tell that. Again, when we think about some of the policies that they've put in place with the bank term funding program, obviously that eases some of the tensions that we have seen with some of the smaller banks. But this was in line with expectations, actually, maybe a little lowered expectations than where we were even a month ago. So I think net, we have been in an environment where we expected these rates to continue to go up as we move further into the year. Companies have adjusted to that. Estimates have been adjusted for that. So really, again, nothing really new today.
Have you shifted your strategy at all, given the recent events over the last couple of weeks, or anything that we heard from Powell today?
Well, we had already earlier this week, last week actually, we did reduce our exposure to U.S. banks, specifically our exposures to the regionals. We're probably neutral to slightly underweight U.S. banks, but we have an overall neutral weighting in financials because we have some European financials as well across our strategy. So we did take some steps on those regional banks.
And how about the larger banks?
We're still neutral there. Again, lowered our exposure somewhat. We had been overweight, so we've pulled that back in just slightly. We are neutral equities in general because we believe that there are still so many uncertainties around growth. But if you think about where the market is priced right now at 17 times forward earnings, there's a lot of expectation for a resumption of positive growth in Q3 and Q4, and then looking ahead to 2024. Since we do have that look-ahead bias, there would be a clearer resumption of growth across many sectors, not just a few.
And as for the probability of recession, Mr. Powell said it's hard to see that this banking crisis helped the likelihood, but a pathway to a soft landing still exists. Has this last few weeks changed your probability of a recession?
Well, we had been expecting that we could have a global recession in the back half of 23, maybe early 24. But then you look at that with, or compare that to where GDP now is for Q1, 3.2%, I believe, quarter to quarter annualized. And then again, growth in the first half of this year. So we're not looking at any data right now that is pointing to a recession. When you think about GDP, when you think about the employment situation, the consumer resiliency, the fact that home builders are feeling better, there's a lot of positive things going on underneath the surface in this U.S. economy.
Rebecca, what do you make of the current employment situation, the fact that the labor market has remained so resilient? We heard Powell talk about that again, saying that the labor market is still too tight. What do you say?
Well, clearly, we know that they expect it to change. I think that they took their unemployment forecast up just modestly in this newest release, but still yet it would be a little higher than where we are now. And that would be expected when you think about the fact that if things do soften a little bit, we've already seen wages start to come down some, and we've seen prices start to come down some. So maybe the situation for employers won't be as bad as has been expected, but we also know that a lot of jobs aren't getting filled that have been posted for quite some time. So there are a lot of mixed signals as we look out over the next several months on the employment front. But the good news for consumers is more of them are employed, and that does bode well for the economy.
Yeah, we're still around 2 workers per every available job in this country, and at 3.6, does it have to break to get inflation down to 2%? And if so, what's going to do that?
I don't know that I have a good enough crystal ball to predict that per se. I wish I did, but I think, again, a lot is going to ride on how tight these bank lending standards get for small businesses and consumers specifically. When you look at the chunk of GDP that consumption is, I think that that's going to be a really important component as we go through the next few months and into the end of the year as it relates to whether or not we have a recession. So there's a lot of uncertainty, which again goes back to our neutral positioning and our strategies.
Rebecca, where do you see inflation right now in the current path that we are on by the end of the year?
Well, you figure, again, CPI is at 5.5%. It is hard to see it going significantly, maybe below. Again, I hate to predict, but when you think of the trajectory we've been on already, it would be hard to get it below 4, I believe, if we were to stay on the current path.
Okay, Rebecca Felton, appreciate that. Thanks so much. Coming up, a series of recent bank collapses have brought new volatility to the market. See what the Fed's latest decision means for the sector going forward. And Nvidia founder and CEO Jensen Huang will fill us in on his company's AI ambitions today at 4:10 Eastern Time. You don't want to miss that. Stick around. collapse of Silicon Valley Bank and Signature Bank created some uncertainty over what the Fed would do when it comes to today's rate hike campaign. But after the central bank decided to raise rates by 25 basis points, Fed Chair Jerome Powell reiterated confidence in the banking system. Let's listen.
Our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Joining us now for more on what this all means for banks is Dick Beauvais, Odeon Capital Group financial strategist. Good to see you, sir. So your reaction to first what the Fed did to stabilize our banking system and then how Jerome Powell characterized it there.
Well, number one, the Fed really didn't do very much. All the Fed did was create a PR program with the Treasury Secretary and the President to assure people that their money was safe in the banking system. And in that regard, that's correct. What is incorrect is that it is not due to anything that the federal government is doing. In other words, the federal government is not coming up with any money whatsoever. So it leads to this point. They haven't to stabilize the banking system. All of the money that has gone into stabilizing the banking system to this point has come from the banks themselves. There are two places you can look for that. Number one, FDIC insurance is totally funded by the banks. So if there's any money that comes out of the FDIC insurance pool, to assist the banks, to assist the troubled banks, it came from all of the banks. Number two, if you take a look at the Federal Reserve, everybody's arguing the Federal Reserve put $300 billion into the banks in the last 7 days. What they're not saying is, where did that money come from? Where did the Fed get that money? The reason that they got that money is because the banking system deposited $440 billion into the Federal Reserve in the last 7 days. So the net effect is, if we would take the focus off the government supporting everything and put it where it's really working, which is in capitalism, which is in the banking system, you will find that the banks themselves provided the money to the FDIC, provided the money to the Federal Reserve, and took that money and used it to stabilize the banks that were in trouble. So I think it is a very important point. I think to the degree that people think that the United States government is the only resource to assist the banking industry, they're not going to believe that the banking industry is safe. Because if the government and the Fed and the FDIC have to step up to stabilize the banks, then no one's going to believe that the banks are safe. If it was understood that the banks came up with the money to stabilize the system, then they could believe that the system is safe. And the system is safe, it's sound, and it's solvent, exactly as Mr. Powell said.
Dick, what about the regulation aspect of all this? Because Powell did say that there is some need to strengthen supervision and also need for more regulation. And since we last spoke, we certainly have still continued to see some jitters out there in the market with the recent selling of First Republic, the selling in shares, I should add. PacWest today, that stock under pressure after the update there from that bank about the deposit outflows. What do you think needs to happen? Has that at all changed from the last time we spoke?
Well, I'm going to go back to the problem in 2008. The Congress set up a committee to look at what happened to the system in 2008. And this, long, thick report, I think it's 600 pages deep. It starts off with the fact that the Federal Reserve did not do its job, that the federal regulators did not do their job, that there were regulations and laws in place, which if these people had done their jobs, you would not have run into the crisis at the magnitude that you saw back in that period. And what did Chairman Powell just say? He said that they didn't do their job. He said that we had the regulators on site, we saw the problem, but we didn't do anything about it. They did not do their job. That means that we don't need new regulations. We need people who abide by the regulations. And that starts with the people at the Fed, and it starts with the people at the FDIC, and it starts with the people at the controller of the currency. If they did their job, which they did not do, we wouldn't need regulation. However, because they've come up with this view that the regulations are not adequate, we're going to see a whack at the banks here, which is going to drive us into a recession. All right, what they're going to do is, the first thing they're going to do is they're going to change the accounting rules, which have to be changed, and they're going to ask the banks to come up with more common equity. So the banks are not going to be, if you will, buying back stock. They're going to be issuing common equity. The second thing that they're going to do is they're going to ask for a change in the structure of how you look at a security. And when they do that, it's going to make it appear that the equity in the banking system is inadequate. So what will the banks do if the Fed comes along and says you don't have enough equity in your bank? The banks are going to reduce credit. They're going to reduce credit to the economy. So the economy is going to get less credit. The cost of the credit is going to go up. The banks are going to have to come up with more common equity. That is going to cause a recession. And therefore, I think it is very clear that by the end of this year, this economy is going to have to live with something it doesn't understand. High cost of money, money which is not freely available at the flick of a finger, because the Fed cannot increase the money supply in order to meet the needs of the banking system, because to do so stimulates inflation. If you take a look at the money supply of the United States at the present time, it is actually shrinking. When have you ever seen inflation expand when the money supply of a nation is shrinking? I mean, I imagine it's happened somewhere, and I imagine, people like Carmen Reinhart, who is a genius, would be able to tell you, I've never seen it. All right, I've never seen it. So if the money supply of the United States is shrinking, if we're going to tighten, if the Fed is going to continue to shrink its balance sheet, if the banks are going to tighten credit, how do you avoid a recession? You can't do it. And therefore, bank earnings are going to be under stress, and people who are thinking about bank stocks right now should think more closely about what they're doing, and where they should put their money is in the preferred issues of the banks, because the preferred issues will not miss a dividend.
Boy, Dick, we wish you sitting in that press conference with Mr. Powell. He also commented on the potential credit tightening and how accurate some of the projections out there are. Let's listen to this.
There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue. And we don't really see it yet. It's so people are making estimates, people are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real.
How will the credit conditions tighten as a result of everything we've seen here?
Well, I think it's clear that, first off, the borrowing is started to weaken in the system already. In other words, if you take a look at commercial industrial loans, they're no longer growing at 10 or 11% the way they were a year ago. They're growing at 1 or 2%. If you look at mortgage credit, it is no longer growing. It's started to flatten out. If you take a look at credit cards, borrowing, credit card borrowings are not growing at 17 to 18%. They're still growing at 14%, but they're coming down dramatically. Auto loan credit is coming down. The banks are going to take a look at the income statements of individuals, and they're basically going to say, I'm not sure I want to lend you this money at this point in time, because the cost of money to me is high. And if I have to pass along that cost of money to you, you can't afford it. Therefore, we're not going to give you the loan.
Dick Beauvais, always great to have you here at Yahoo Finance. Thanks so much for hopping on with us this afternoon. We look forward to having you back.
Thank you.
All right, continuing our Fed coverage here with the Fed raising rates by 25 basis points, and Fed Chair Jay Powell reiterating the fact that the Fed is going to do what it takes to bring down inflation. Jen Schomburger was at the press conference in the room, got a question to the chair himself. Jen, your big takeaway.
Hey there, Shauna. Good afternoon. Fed Chair Powell said that emergency actions that the central bank took to contain the bank runs demonstrates that all deposits in the system remain safe. He said the central bank will continue monitoring conditions and will use all tools as needed to keep the banking system sound. Now, Powell also echoed Treasury Secretary Yellen in saying that the action that regulators took to implicitly guarantee deposits was because of of risk for contagion to other banks and financial markets more broadly. In a moment of frankness, he was asked what he thought when Silicon Valley Bank failed, and he admitted that Fed officials asked what exactly happened here. Now, he said that he does expect credit conditions to tighten, and I asked Chair Powell how he views financial conditions now and whether credit conditions were to tighten enough, if that would prompt a rate cut and a reevaluation of the balance sheet runoff. Take a listen.
Financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it? And then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time.
Now, Fed Chair Powell said that officials did consider taking a pause leading into this meeting, but when weighing the stronger than expected inflation and jobs data, and given that inflation remains still well above the Federal Reserve's 2% target, it did prompt a 25 basis point rate hike. Having said that, he is looking at credit in this economy, and if credit tightens enough, that could do the Fed's job for it. He said that the tightening doesn't necessarily have to come through Fed rate hikes, it could come through the credit side of the economy. He was also asked whether a soft landing is still on the table. He says it's too early to say at this point. Back to you.
Jen, we all turned word detectives on this day, and so everyone's eyebrows raised when it was additional policy firming, and Powell was asked about that, and he said I would focus on the words may and some as opposed to ongoing. As for future rate hikes, what do you make of the change?
Yeah, hey there, Dave. I think what he's looking for is flexibility here. He made a lot of points about credit tightening and how that could do the Fed's work for it. And we're still very early in the innings here. He admitted that we're not really sure what the effects are going to be here, how this is going to ripple through, and how this is going to impact growth. And thus, they want to be able to stay nimble here and have both sides of the coin, which is if it doesn't have that big of an impact, then they can continue raising and even raise higher than, the 5 to 5.25% that they're projecting as the peak right now. On the flip side, if the economy and credit deteriorates, they have the wiggle room to also perhaps, if needed, cut, even though he says no cuts on the table this year.
Remaining data dependent. Jen Schauberger, terrific job today as always. Thank you so much. When it comes to our coverage of the Federal Reserve, you've heard a lot of references to the dot plot. So what do all those little dots mean exactly? To explain, we welcome in Julie Hyman, who plots dots just for kicks.
Sure.
And you were doing that the second we saw them out. So we look forward to your explanation.
Yes, I have been plotting the dots. This is the current Fed dot plot. This is what they came out with today. They also call it the Summary of Economic Projections, and it includes other stuff like their GDP projections as well as inflation projections. And all of it comes down to the so-called dot plot. All the dot plot is the individual Fed members' projections of where interest rates will end up by a given point in time. So when we hear, for example, Jay Powell say in response to Jen Schauberger's question, we don't anticipate a Fed cut this year, an interest rate cut this year. This is where that comes from. So let me explain a little bit more here. So here's where the dots are for this particular point in time for the end of 2023. Well, I'm not drawing, but there you go. You see where the dots are. Each dot represents a person. That's all the dots are. The dots are people. The dots are members of the Federal Open Market Committee. Some of them are currently voting members. Some of them are not currently voting members, but it's where all of them anticipate rates to end up. And none of them are anticipating a cut because this dot right here is where we are now. So it looks like one member is expecting that we will not see a further increase this year, but the majority of the dots, 10 of them, are clustered around the 5 to 5.25% range there. And then we see a couple that are above that, one that's even between 5.75% to 6% by the end of 2023. This column here is 2023. Then you have 2024, and you see a lot more dispersion because it's further in the future and therefore more difficult to predict. And there's even difficulty in predicting what the Fed is going to do at the next meeting, let alone what they're going to be doing in 2024 or 2025 or in the longer run. But this is their best guess. And you even see a dot right at around 3.5 to 3 3/4% here for going into 2024. So a bigger dispersion. So this is the Fed's projections. But like most projections, there's an element of guessing. We don't know if this is what the Fed will actually do because the Fed can't predict the future. And the Fed is, as Jay Powell likes to remind us, data dependent. They're watching those credit conditions very closely. So here's the current Fed dot plot. I do want to see where it was in December because there is a little bit of a change here. You've previously had 2 dots that were closer to the 6% level, so we've come down a little bit. Still, though, the majority of the dots are not changed, clustered around 5 to 5.25%. So in that sense, where the Fed perceives its so-called terminal rate, where they're going to end this hiking cycle, that has not significantly changed between December and now, even though a lot has happened in between, including some persistent inflation figures and, of course, the collapse of Silicon Valley Bank and others and the tightening of credit conditions. So that's all the dot plot is.
Look, I believe.
He's coming over here.
I'm coming over.
Let's do it. Tell me.
In the John Wooden theory of surround yourselves with smart people who will argue with you. So this concerns me. I like this because it represents dissent. Agree? Like there's very little dissent among these people.
Okay, let's go back. Let's go back to where we are now, by the way. There is dissent now. That was 2020. The reason that those were all in the same
I'm just
line.
saying, generally, I like to see some dispersion. I like to see some, this to me, see, now we can draw.
See, now you can draw. You don't like to see. Why are you so focused on them arguing? Why do you want them to argue so badly?
Because that's how we come up with the right answer. We never come up with the right answers in life, just everyone saying, yep. We come up with the right answers by fiercely debating subjects, no matter what it is. I just think, look, we can all disagree on what we want to see. You like this, huh? You like agreement.
Well,
we disagree. You and I are vertical on this.
Do you think they shouldn't have increased by 0.25%?
I do think this was the right call. I just like to see.
If
you get what I'm saying?
I get what you're saying, but if you end up getting to the right place, I mean, is the problem, did they misjudge that inflation would be transitory because there wasn't enough to set in the Fed?
Oh man, you're going deep.
I don't know.
You're going back.
I don't know.
Did they misjudge?
The meeting was pretty fiery. I don't think everyone was agreeing on everything.
Yeah,
I think the impression I get.
Behind the closed doors, if you read the minutes, sometimes there is more dissent.
I loved it was a perfect explanation. Sorry to scribble all over it.
That's okay.
That's what I do.
I tried to scribble and it didn't work.
I color outside
thank you for
the lines. All right, thank you, Julie. Coming up, workers across 100 Starbucks stores are greeting the company's new CEO with a strike. Find out why when we come back.
time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading, final 10 minutes of trading today. We've got Krispy Kreme, Petco, and Starbucks. Kicking it off with Krispy Kreme. Volume on the stock today soaring to more than 7 times the typical average here. It's the biggest intraday jump that we have seen in just about 10 months. And the move higher comes after Truist upgraded Krispy Kreme to a buy. They say that the deal with McDonald's to sell some of its donuts in select restaurants is, quote, underappreciated and could help boost brand awareness and also potentially drive sales. They also think a normalization in the dollar will help Krispy Kreme, given the fact that the company has been growing its international exposure. Now, shares have soared since the start of the year, skyrocketing more than or just around 50% since January 1st here. And Allie, when we take into account everything that has happened with Krispy Kreme, obviously this McDonald's partnership, I think, is so smart. It's just in Kentucky. I think a lot of people, a lot of investors, shareholders want to know if they're planning to expand it beyond that state, given the fact that it seems like it has been a success so far.
I think they certainly should consider expanding it, and I do agree with this analyst that I think that is a largely underrated part of this business. And you were talking about some of the improvements in foreign exchange, and about a third of Krispy Kreme's sales comes from international markets. So that's a potential tailwind. This analyst also cited the fact that more people are returning to the office as a good play. Also saying that Krispy Kreme is one of the few packaged goods companies to post meaningful volume growth in 2023. So as long as they can continue to add to that top line growth as competitors decelerate, that's a strong move for this buy rating.
Yeah, this is really the new fast food wars is breakfast. Jumping off the McDonald's aspect of this, Wendy's is pouring money into it. Taco Bell is pouring money into it. Obviously, Dunkin' Donuts is pouring money into it, and they're going with breakfast tacos is their new launch. In fact, just launched breakfast tacos today. And Taco Bell's CEO, Mark King, said, we have to go after McDonald's. It represents $1 billion sales opportunity. We have to commit to beating our rivals. This is really the place to watch. What used to be the chicken sandwich wars, I think is now the extra opportunity of breakfast, and that's what to watch for all these fast food companies in the years ahead.
Well, I'll stick with the animal theme, from chicken to dogs, because are the dog days over for Petco? That is my play today. Ticker Wolf, down more than 16% today after reporting a miss on the bottom line. In addition to softer guidance, revenue coming in at $1.59 billion, a slight beat there with adjusted earnings falling short at 23 cents a share, 18% lower than last year. Disappointing guidance hints at how challenging macro conditions remain a top concern as the consumer remains cautious. The company saying it expects fiscal 2023 revenue to come in between $6.15 to $6.28 billion, with fiscal 2023 adjusted EPS projected to be down 13 to 21 cents. This, of course, coming as 2023 sales are expected to grow by just 2 to 4%, with the possibility that same-store sales could decelerate, along with more muted gains in services and e-commerce. So overall, not really a great picture for Petco this morning, especially as other risks like inflation will be a continued headwind throughout the year. But Yahoo Finance did have the chance to speak with Petco CEO Ron Coughlin this morning. Take a listen.
We are more and more becoming a services business, to your question. In terms of Vital Care, we got to 500,000 customers. Those customers are spending 3.6 times more than an average customer. And importantly, they're margin accretive from a dollar standpoint to our business. So those are positive trends.
So really sort of shifting away from the goods and moving into solely services and kind of relying a lot on that to help drive sales.
Makes sense. That's how our shifting has spent from goods to services. I saw that myself, went to drop my dog off at the groomer this morning. Turns out I didn't have a shot. Had to go get him a shot, then bring him back to the groomer. There's Cooper. Isn't he cute?
He is very
Oh my
cute.
gosh. And you know, just plunks himself down right in the middle of us. No privacy in my family. But yeah, services is an interesting shift for them. I also thought it was interesting on the call, Ron Coughlin said, Gen Zs and millennials continue to be the largest cohort of adopting new pets and the highest spenders, bringing elevated and accretive spend per pet. So zeroing in on that demographic, that's who's spending.
And I think it also brings up the question that maybe the spending on pets, even though some people still are, maybe it's not as recession recession resilient, recession proof, as we've talked about in the past. We talked about the fact that a lot of people will still spend on their pets despite the macroeconomic, despite the fact that we could start seeing some challenging times ahead. And if you take a look at that consumer spending, yes, the CEO is upbeat, but we are starting to see consumers pull back a bit.
We'll spend anything on Cooper.
I know, Cooper.
All right, anything. We started with donuts, we finished with coffee. My play is Starbucks. New CEO Laxman Narasimhan replaced Howard Schultz on Monday, and all of 2 days into his new gig, he's welcomed with a strike. Starbucks Workers United organized a strike at an estimated 100 cafes across the country in what they're calling a National Day of Action. The union demanding an end to what they call illegal union busting, releasing a statement reading, quote, "While the company keeps a metaphorical empty chair for us in the boardroom, we're demanding a real seat at the table." Now, we can't confirm how many stores did participate in this strike. There are reports of strikes Michigan, Arizona, and Colorado, Minnesota, and Virginia, to mention a few. Here's the list, the union says, of all the stores that had planned to join the strike. Their founder and CEO, Howard Schultz, will appear before the Senate next week after pressure from Bernie Sanders. But back in 21, Starbucks raised their minimum wage to $15 an hour. Baristas earn an average of $17. They go up to $23. We'll check out shares today. I think they're relatively flat, and relatively flat for the year as well. I don't know how you guys feel about this, but $15 an hour minimum wage for a barista. Come at me on Twitter, fine. That is more than an adequate wage, averaging $17.
A lot of times you get tips.
Seems pretty darn fair to me, and most times you get tips.
Yeah, most times you do get tips. I agree with you. I do agree with you on the pay. I think that this new CEO certainly has an uphill battle, at least over the next several months. He's coming into a company when there is a lot of turmoil, when you take into account all the baristas that are very, very upset about this, the culture there needs to be some sort of shift, and what that shift will be, obviously in tone and how some of these situations are handled. He's not going to have an easy ride here. There's going to be lots of questions that people want answers to, not only his employees, but also shareholders, investors as well.
There's questions on the other side as well, though. Republicans in the House are questioning the National Labor Relations Board and whether they handled this inappropriately on the flip side of this. So I think they're a preemptive strike against what's about to come down on Howard Schultz.
Yeah, regional representative there. That's being questioned. All right, well, coming up next, we are counting down to the closing bell on Wall Street, and Nvidia founder and CEO Jensen Huang will tell us what the tech company has in store for the rest of 2023. Don't go anywhere.
We are a minute away from the closing bell. That's time for Jared Blickery to break down the action on the day. And it's always a volatile time when Mr. Powell is speaking. How was it today?
That's right. Green has turned to red. Nasdaq now leading the way down about 1.4%. Had been leading the way up. Even Bitcoin down about 4%, and that has been leading the market. But I do want to hit on some fringier parts of the market. First, Carvana. That's up 6%. They did pre-announce, and it was lower than expected revenues, I believe, but they are in the process of trying to restructure their debt. That's what the street is excited about here. Also tracking GameStop. Now they swung to a profit and they are up 35%. Best day since GameStop 3 years ago, guys.
All right, well, that wraps up today's trading day. And as you can see, all three of the major averages in the red. You're a fan of that.
Did you just skip over? Can we take a shot of that again? I mean, Shauna, you got to pay attention.
I saw it. I was giving it to you.
Okay,
Look at that.
so
All
this
the
is
mascots of
celebrating March
Tennessee.
Madness.
Exactly.
And in particular, the games that will be at Madison Square Garden. You see Florida Atlantic, the Owls. You see the Vols, Michigan State.
There we go.
You almost glazed over
I
that.
saw it.
And
I knew we were going to talk about
upset.
it. I was getting the people what they wanted. They wanted to know where the major average, and then we were going to talk about
We're just a couple of minutes from Madison Square Garden, and all the fans were so excited to see Duke, maybe FDU, which is 14 miles from here.
Excited to see these four.
No, they're not. Not locally. No, they're not.
Who do you got?
Tom Izzo, Michigan State, at MSG. Alabama wins it all, by the way. Okay, move on.
All righty. Well, let's get a check on where we did close today. Again, all three of the major averages in the red. One of the sectors that were under a tremendous amount of pressure, really touched the lows of the session, I should say, during the comments that we were getting from Fed Chair Jay Powell, was the banking sector. A number of the banking names falling into the red today. The regionals, among that, obviously the losses in PacWest. That was a story for much of the day following their financial update in terms of the outflows that they have seen in their deposits since during the first 2.5 months of the year, specifically over the last couple of weeks when we started to see some concern there in the regionals.
But they did raise about $1.5 billion to try to assuage investors' fears. And they say that the outflows or the deposits are stabilized, but clearly investors are not buying the stabilization of PacWest because it fell dramatically after that news came in. In fact, in the last hour, dramatically. We were down about 9% when we first talked about this story around 3 o'clock, and now dramatically fell towards the close. KRE is always interesting. The regional bank ETF down substantially, and First Republic just continues to take a beating. So overall, not the stability that Jerome Powell was talking about, probably not the reaction he would have been hoping for.
I guess not the reaction, but I don't think it's as worse as maybe it could have been, given the fact that the Fed did not pause. The Fed raised rates. I think a lot of the commentary in terms of the reaction that we saw in the broader markets was Powell once again staying true to what he has said from over the last several meetings, and that's the fact that the Fed is going to remain committed to getting that inflation rate down to its 2% goal. They will hike more if that is what it takes in order for them to reach that goal. So that hawkish tone, I think, was enough to flip the momentum in the markets.
Let's talk more about that. Fed Chair Jerome Powell noting in today's FOMC press conference that the Reserve did consider halting its rate hikes, but ultimately decided to continue on its path and hike interest rates by 25 basis points. Joining us now is Mark Zandi, Moody's Analytics Chief Economist. Mark, good to see you, sir. What was your reaction to the 25-point hike and to that language that we've continued to focus on, which of course is additional policy firming, a slight tweak from prior meetings?
Well, I was disappointed. I thought that they should pause in their rate hikes. It seems very incongruous that 1 week you're establishing a credit facility to provide liquidity to the banks so they can pay off depositors, take pressure off the banking system. And then the next week, you're raising interest rates, which will clearly put pressure on the banking system. So I don't know how to square those two things. I think they the Fed tried to thread the needle here, kind of a dovish rate hike, but I don't know that it doesn't look like they succeeded in doing that. So I fear that they are exacerbating the concerns out there. And I think it was a mistake not to pause.
So exacerbating some of the concerns out there, what does that mean specifically for the banking system? More chaos, more failures?
It shouldn't, right? I mean, look, the system broadly is in very good shape, lots of capital. I think liquidity is fine. And the government has stepped up and done a lot. ensuring deposits of all depositors of failed institutions. I mentioned the credit facility the Fed established. They're ripping out the weak links in the system by either shutting down weak banks or forcing others to merge with stronger banks or cajoling the big guys to help the small guys. So, they're doing all the right things and they're doing it very quickly. But, the confidence is very brittle, and it was brittle coming into this. And so I think the priority should be, judging by the reaction here, it remains to be establishing confidence in the financial system. That's got to be the first priority. Now, inflation is high, too high. You got to get that in. But, I think the first thing to do is make sure the system's on a solid footing before you can pivot back and start addressing the high inflation again.
Of course, Mark, the theory goes that if they did not raise, if they paused, then that would have led to some panic. Oh, maybe things are worse than we otherwise thought. And Brian Belsky told us earlier, he thought if they paused, the markets would fall dramatically on that news because the interpretation would be, oh boy, things must be worse than we think. Your thoughts on that?
I don't get that at all. I don't understand that at all. I mean, it's obvious the banking system is under a lot of pressure. It's not, last week we had bank runs. It was very clear to everybody that the system is under a lot of pressure, remains under pressure. And so I don't know that you're fooling anyone by saying, oh, I'm increasing rates because I'm not worried about the system. It doesn't fool anybody. So I don't get that at all. I don't understand that psychology. Who knows? I don't know what the counterfactual is here, but my sense is if the Fed paused, we'd see green on the screen, not red at this point in time.
Mark, the Fed didn't pause, and Powell said if more hikes are needed, then they are going to do that. Does that make a recession a sure thing? And I guess how deep of a recession could we see?
No, it's not a sure thing. I mean, we do need a little bit of luck. I mean, we can't. The banking crisis can't continue on here. We can't get hit by something else, and we need some reasonably deft policymaking, good policymaking by the Federal Reserve. And if so, then I think the strong fundamentals of the economy will continue to shine through, and we'll avoid an outright economic downturn. So no, I don't think it's inevitable, but I do think it's important that policymakers recognize the risks here and focus on it, make the system, the financial system, priority number one. We've got to make sure, and it's not just about the reality of whether the system is sound or not. I think it is. It's about making sure that people are confident that they believe that the financial system is sound, and that's what hasn't been repaired yet. I mean, how could it be? It was just literally not more than 10 days ago that we were struggling with bank failures and bank runs and concerns about the system as a whole. So it's hard to believe 10 days later you feel like everything is fine. It's not. And so I think that they need to establish that confidence. But if they can focus on that and get that done, I think the economy has a lot of things going for it, and we should be able to navigate through without an economic downturn. It's not going to be easy. I'm not saying it's not going to be really bumpy and uncomfortable at times. Like now, it's pretty uncomfortable, but I think we'll be able to navigate through. But I say that with less confidence today than I would have said that 2 weeks ago.
Well, that is the dissenting opinion I have longed to hear. Mark Zandi, good to see you, sir. Thank you for that perspective. Coming up, Yahoo Finance's Julie Hyman and Dan Howley sit down with Nvidia founder and CEO Jensen Huang. Don't go away.
Welcome back. I'm Julie Hyman with Dan Howley sliding in here. Nvidia is ramping up its push into artificial intelligence. The company unveiling new plans at its annual GTC developer conference of making supercomputers used to develop AI technologies and a whole other suite of products. Not, by the way, just chips. For more, we're joined by Jensen Huang. He is Nvidia founder and CEO. Jensen, great to see you. Thank you so much for being here.
Delighted to be here, Julie and Dan. Nice to see you.
Thank you. You have been saying that this is the iPhone moment for AI. Tell us what you mean by that.
Well, several reasons. One, this is the first time that AI has reached an inflection point such that this AI capability is so easy to use. Almost anybody can program it. You can program it to develop all kinds of interesting applications, and it's so accessible. And so when you think about a new computing platform, whether it's the PC, the internet, the mobile cloud revolution, every generation, the number of applications, the number of programmers, and the reach of that platform increased. And this is absolutely the case. You could see this with ChatGPT, the AI heard around the world. In just a couple of months, it reached 100 million users. And the number of startups, the number of applications that you're now starting to see on generative AI is just growing extraordinarily. So this is definitely the beginning of a new computing platform.
Jensen, I want to ask you about the generative AI aspect. We saw a lot of that kind of in your keynote, the talking about generative AI. And NVIDIA made some announcements, partnerships with Adobe, for instance. Where does generative AI, though, fit into your broader portfolio when it comes to AI?
Well, first of all, we're a full stack computing platform. We start out with the AI infrastructure, and this GTC, we announced a massive deployment of Hopper generation. AI supercomputers are being deployed all over the world. But very importantly, this is also the first generation where AI is moving out of the laboratories, out of research, and into industrial operations. And so instead of just a supercomputer for training, this is going to be now an AI factory for every industry and company to produce intelligence. Whereas companies in the past would build, factories for all kinds of different products and different things. In the future, there will be factories that are created for every company so that they can produce intelligence. And so this is really an extension, a major extension of how AI is going to be used. Generative AI is behind that. The second thing that we do is, of course, the operating system and the software stack layer of AI. We have two platforms for that. One is called NVIDIA AI. The other one's called NVIDIA Omniverse. NVIDIA AI is where intelligence is created. Omniverse is where intelligence simulated and tested. One is a virtual intelligence. The other one's virtual world. And these two platforms we have now put into the cloud. And so in doing so, we're partnering with the world's CSPs to take the best of NVIDIA, the NVIDIA AI DGX supercomputer, the two NVIDIA platforms, NVIDIA AI and NVIDIA Omniverse, and we're now making it available as cloud services, all hosted inside the world's leading CSPs. And so in partnership with the CSPs, we're going to combine the best of NVIDIA and the best of the leading CSPs, and we're going to bring AI to the world as quickly as possible.
And Jensen, you're good at sort of laying out this grand vision, right, for those cloud service providers, for those clients. We're looking at some cool pictures, too, of how this is all going into play. You talked to us a lot last year at this time about the Omniverse. So I have two questions for you. First of all, to sort of make it concrete for those of us who are not steeped in this stuff all the time, what are some examples of this being put into practice? And how is your Omniverse different now than it was last year? Is it that being put into the cloud aspect?
Well, so far, Omniverse has only been an on-prem enterprise solution. And the fact of the matter is, this stack, this supercomputing stack, artificial intelligence stack, is really complicated. And the answer is to put that up in the cloud, for us to fully manage it, host it, manage it. We host it from Azure and benefit from all of the security and all the industrial certification, all the storage capability, and all of their enterprise APIs, and all of their productivity APIs. And they've also done a lot of work with with industrial metaverse. And so all of that work is now going to be tied into Omniverse, and we can take this to the world. What Omniverse is to help companies that build physical things to do everything digitally first. And so whether you're building cars or making, devices or phones or, building plants or factories, logistics warehouse, or designing large buildings, or even designing cities. Today, you have to do things kind of on paper, and then you try it in the physical world. And as you're building it and you make mistakes, you do change orders. All of that doesn't have to happen. You should be able to do that completely in digital. And when you do it in digital, all of the organizations around your company, and these, the car industry has 14 million employees, and it takes all of those employees working together to build a car and manufacture it around the world. And so now these 14 million employees could have a digital platform that connects digital and physical, and for them to be able to design the cars, design the factories, all in Omniverse, use generative AI to test it, to help populate it, to optimize it. And then before they do that, they virtually assemble it before they break ground and build a factory in reality. In doing so, the number of change orders will reduce, the time to market will reduce, any plant opening delays would reduce. For an industry as large as the auto industry, which is $3 trillion large, all of this is going to translate to hundreds of billions of dollars of savings. So this is a very, very big deal that we can help the physical industry of the world become digital for the very first time.
Jensen, I want to ask real quick about AI and the cost of it. We've heard stories about how OpenAI, they're basically subsidizing ChatGPT at this point. When it comes to generative AI and these kinds of services, obviously NVIDIA's chips are very important. I guess how does that, is the company able to help clients at all as far as pricing goes? Is there a means for lowering the power cost? How does that kind of square?
Yeah, first of all, artificial intelligence is a two-computer system. The first computer is the training system, and this is what's sitting behind me. This is the Hopper DGX GPU. This is literally one GPU. It's got 8 different chips connected chip to chip using a really high-speed interconnect. And what the computer sees, what the programmer sees, is one giant GPU, the largest single chip, if you will, the world's ever made. Now, this computer trains the model. It develops the model. This computer works with software programmers to create the software, create the AI. Once the AI is developed, it is then run on a second computer. And the second computer could be as small as this. This is what's deployed at Google GCP. And this will run generative models for imaging, generative models for video, generative models for languages. Of course, there's a limit to how big models can be in this GPU. And we could create even a larger version of the GPU for inference. And that version is, for example, this one. And this is designed for large language model inference. And so all the way from this little tiny guy, which is called L4, which could be deployed all over the clouds, to this version, which is designed for large language models. And they run programs that are created by this computer behind me. And so inference has large range of scales, just like applications have all different sizes and shapes. Some of them require larger computers, some of them require smaller computers. And so that's number one, is we announced a whole family of generative AI platforms that range from L4s to L40s to H100s to our next generation Grace Hopper that allows us to inference in a broad range of applications, all one architecture, all software compatible for different sizes and different performance levels. Then the next thing that we have to do, and just by the way, this Hopper H100 MVL, in just one generation, we reduced the cost of large language model inference like ChatGPT by a factor of 10, 12 times in just 2 years. And so we're going to continue to do that. The combination of new architectures, new configurations, and new software technology, we should be able to do the same for AI in the coming years that we've done for the last 10 years, which is we reduced or we enabled the capability of AI to grow by about 1 million times. That million times the performance wasn't increased by, wasn't supported, wasn't followed by an increase of a million times in cost. And so we should be able to do the same thing over the next 10 years and drive down the cost of inference tremendously.
One of the interesting things that you guys have been doing as you've been building out AI, but not just that, is you're not just a chip maker at this point, right? I think people think of you as primarily, Nvidia is a chip maker, but you've got more software and services now that you're adding on. What sort of led to that decision, and how do you foresee that balance going forward? In other words, like, should we think of Nvidia as a chip maker anymore?
Well, first of all, the services part of the software part of our business is going to increase over time. However, the systems part of our business, or the chip part of our hardware part of our business, will continue to be very large. The way that NVIDIA does things, accelerated computing is a full stack problem, which means you have to design an original chip, an original system software, brand new algorithms. And one of the algorithms that I mentioned during the GTC this time, of course, we talked a lot about generative AI, but one of the really important ones was computational lithography for chip making. So that's an example of a very important library that we created. Another one would be data processing, we call RAPIDS. Another one would be quantum computing, we call cuQuantum. There's a whole bunch of libraries that we created. There's some 300 libraries or so that are for use for different domains. The way that if you're a software company and you're creating a whole full stack, you have to start from building the system itself. And so the way that NVIDIA builds things, we build the entire data center, from the chips to the systems to the software to the networking, the switches, the computing fabric, all of the algorithms on top, and we bring it all up and we make it all work and we optimize it. And then the second thing that we do, and this is the part that's really magical, we disaggregate, we break everything down again, and we integrate all of our components, whether it's this size or this size or this size back here, we integrate it into the world's computing fabric through our OEM partners, our system integrators, our cloud service provider partners, and we integrate them into their computing system. And so as a result, NVIDIA is really an extension of everyone's computing system. And so Dell has an NVIDIA extension, HPE has an NVIDIA extension, AWS, Azure, GCP, OCI, they all have NVIDIA extensions. And as a result, we have this giant footprint of one architecture that's called the NVIDIA architecture that every researcher, every developer, every startup, every company could take advantage of because it comes from literally everywhere. And so it seems like we're a chip company, but we've always been a full stack systems company. And now as we move further and further up the stack, and we build those stacks because the world needs us to do it, if it's available anywhere else, we wouldn't do it. But NVIDIA AI and NVIDIA Omniverse are so unique that we really ought to put that into the world's multi-cloud, any cloud, and allow you to be able to run those stacks everywhere.
So Jensen, as you talk about this increased suite, I mean, the broader technology industry, as we know, this is sort of the year of efficiency, not just for Meta, but that seems to be the mantra for a lot of large tech companies right now. How is that affecting your business, even though they might be longer term, very pro AI, very interested in it? Are you seeing sort of delays in decision making right now, for example, because of the environment?
We are seeing an acceleration of demand. We're seeing an acceleration of demand for our DGX AI supercomputers. We're seeing an acceleration of demand for inference because of generative AI. In fact, was that the major theme of GTC is really that accelerated computing and AI have arrived, and both of them must be activated as quickly as possible to drive lower cost. I showed several examples where accelerated computing applied to computational lithography, computer-aided engineering, data processing, to even combinatorial optimizations for route planning could be improved dramatically in speed, but also reducing power by order of magnitude, reducing cost by an order of magnitude. The world is really challenged in not just the fact that we all have to save money and be more efficient, but in the world's data centers, we're power limited. And so in order for us to continue to increase performance while continuing to be sustainable, we must, number one, accelerate every single workload. Number two, reclaim that power. So if we used to spend 35 megawatts of power, let's reduce it down to 5 by accelerating the workload, as I demonstrated at GTC, then use the 30 megawatts to now go back and invest that reclaimed power back into growth. So job one is now to accelerate computation, accelerate everything we can, reclaim the power, reinvest that into growth. Now, artificial intelligence has the incredible capability of predicting the outcome without doing the brute force computation. Brute force computation takes a lot of energy. And so the work that we're doing, for example, in Earth 2 to predict the weather and predict the climate, we're able to now predict weather nearly as accurately as first principled analysis and simulations, but do it 10,000 times more efficiently. And so instead of using a ton of power in supercomputing centers that does all the computation, we should accelerate it. We should use artificial intelligence to make the predictions, and as a result, reduce power, reduce time, reduce cost.
And so, Jensen, even though you're talking about reducing costs in this particular area, I mean, Nvidia is not now just an AI company, right? It still does other stuff. It still does gaming. It still does auto. Still does data center. To your point, that's not necessarily AI powered at this stage. And so, if demand is increasing for this area, how is that balancing with what you're seeing in demand for some of your other products in those other areas? And also, what's the proportion of your sales right now that are in these AI products, and how do you see that the trajectory of that through the end of the year? Sorry, a lot of questions
answering
there.
it backwards, I would say that that was a lot of questions. Data centers largely driven by artificial intelligence and accelerated computing is already our largest business. I expect it to remain our largest business through the year. And this is an area that we're seeing accelerated growth in demand in both training as well as inference. The gaming market had a very challenging year last year, and we see it returning. And we're doing very well with Ada. Ada is the world's generation of it's based on a technology called neurographics, which basically says instead of computing every single pixel, we render one pixel and we guess the other 8 or 16. This is just an amazing thing. We're using artificial intelligence, one large computer in our data center, and we save power for hundreds of millions of gamers. And so this way of doing computer graphics is really essential in the future. We've demonstrated incredible visual quality improvement, incredible performance, and simultaneously reduction in power. And so we're going to apply artificial intelligence to gaming. We're applying artificial intelligence, of course, to autonomous vehicles. AV and all of our auto business has nearly doubled. I think it's about more than doubled year over year. We expect next year to be another very big year. And so this year to be a big year, next year to be a big year. We're ramping into autonomous vehicles. We're ramping into electric vehicles. And very importantly, we're ramping into a whole generation of cars where the car makers realize now that they're really software programmable cars. And what they need to do is to build an install base, a very large fleet of install base, because that install base will be on the road for 15 years, that they can benefit from new software offerings and new applications that they can deliver to their customers and monetize that relationship for 10, 15 years. And so people now start to realize that NVIDIA is really the great choice, the best choice for those software programmable AV electric vehicles.
Jets, I just have one last question for you, and it's just about interest rates. You know, we saw Jay Powell talking about raising rates again. How is that impacting some of your customers? Are you seeing them, we're obviously talking about pullback, not pulling back as far as AI goes, but how else are you seeing that impact the business?
Well, this is a time when we all have to do more with less. And not one company wants to do less. Everybody wants to do more, but they have to find a way to do it with less. Accelerated computing is really the best path forward to do so. The ability to roll up your sleeves and refactor your software, deploy it, that exact same software that's now refactored, and we have all the skills and the capabilities to help them do that. Once you refactor the software, you could save extraordinary amounts of money. The $1 trillion, what is it, about half a billion dollar spend of cloud computing these days, the vast majority of it is in data processing. All of that should be accelerated, and we can help companies do that, accelerate that, reduce the spend, even improve their performance, and very importantly, reduce the carbon footprint, reduce the power dissipated in order to do that job. And so across the world, accelerated computing is really the best way to do more with less.
Jensen, thanks so much for talking to us and spending so much time with us. It's always a really fascinating conversation for sort of the bigger world and also for NVIDIA investors and customers as well. Jensen Huang, NVIDIA founder and CEO, and our Dan Howley, of course, as well. Thanks.
Great to see you guys. Thanks, Julie. Thanks, Dan.
Thanks. We're going to be right back with much more Yahoo Finance Live. Stick around. Let's do a quick check on the markets here, sponsored by Tasty Trade. Again, all three of the major averages closing in the red following the comments that we got from Fed Chair Jay Powell during his press conference, and also some comments from Treasury Secretary Janet Yellen. She was testifying in front of senators earlier this afternoon. You're looking at losses across the board. The Dow off 530 points, S&P off just around 1.6%. The Nasdaq closing off just shy of 200 points. All right, well, the Fed raising rates by a quarter of a percentage point here, 25 basis points. Fed Chair Jay Powell admitting that the Fed did consider pausing the rate hikes in the lead up to the FOMC meeting after the fallout from the banking crisis, but they went ahead and continued on their rate hiking path. Joining us now is Pete Baden. He's Giona Asset Management Chief Investment Officer, and this week's ETF report brought to you by Invesco QQQ. Pete, it's great to see you. So first, just your reaction to what we heard from Fed Chair Jay Powell and also the reaction that we saw in the bond market this afternoon.
Well, thanks. It's great to be here, and thanks for having me on. My reaction to what Fed Powell did, I think he did the best thing he could. He had to raise rates because he promised us a rate raise. but he also had to walk this fine line between being too harsh and crushing the economy and going too far, and also being too dovish, because if he's too dovish, then all of a sudden people go, wait a minute, what does the Fed know that we don't? And why are they all of a sudden so concerned about what's going on? So I think he walked that line pretty finely. And if you look at how the market reacted, first off, bonds going down is a good thing. If the bond portfolios are going up, then maybe the unrealized losses at the banks won't be as bad. And two, it really didn't get really ugly until Janet Yellen was doing her testimony, and she basically said, we're not really up for more than all of the guaranteeing all the deposits at all the banks. And, then all of a sudden we end up here with some losses and, some nice gains in the bonds.
So given all that, what does it mean for your investment strategy moving forward?
We're still looking at the longer bonds. We've been long the 10-year, and we certainly like that place. We're thinking a little bit, taking a little bit off of the 10-year. We think that there's some potential numbers coming up here that, again, it's not a straight line from here to 2%. There's going to be some rocky roads, and you might see some volatility in that 10-year. So we're moving some stuff back into the 6-month. We still think that's a great place to be. Definitely trying to, moderate our credit exposure going into things like corporate bonds or even some of the mortgage-backed securities. Still think munis are great, but definitely want to be rate dependent on those.
Pete, you got some ETFs for us here for investors out there who are looking for exposure to the Treasury market, looking exposure to fixed income. What do you have, and when would some of these investment opportunities make the most sense?
Well, right now, we're certainly looking at the U10 opportunity out there. It's up nicely today. And if you don't want to necessarily take that kind of a duration risk, then U2 certainly has had a nice movement today also. And then, both of these are only single security ETFs. So you only own the cash bond in the ETF. It's not like you own a section of the curve or something like that. So it's pretty straightforward. When you look at something like T-bill, which is the 3-month US Treasury, then you got a chance to really just have almost like a cash surrogate. It's very stable, really nice yield. And then you can pick up yield going out to X-bill, which is the 6-month, or O-bill, which is the 12-month. So all of those, you can combine them, make a very nice duration play into your portfolio, add some duration by putting U10 in, take some off by switching in U2 instead of U10, and really be able to play rates back and up and down the curve, and also have great liquidity, because these trade are the most liquid fixed income securities going. We recently just hit $1 billion, and we're going to be launching the other 5 in the series on Tuesday. We're going to be listing those with Nasdaq. So we'll have the 3-year, which will be UTRE, the 5-year, which will be UFIV, the 7-year, which will be USVN, the 20-year, which will be UTWY, and then the 30-year, which will be UTHY. So each of those will be coming out here on Tuesday, and we look forward to seeing how folks will be using those and using those to help their portfolios and get liquidity in fixed income.
And Pete, in this environment, what's the biggest downside to that strategy?
In this environment, it's the volatility. You've got chances that inflation rears its ugly head, or Fed changes direction yet again, something like that. But you do have a really nice current yield on these to help mitigate some of that loss. And there's certainly a good place to be if things are really going to get ugly and we're going into a recession. Typically, long bonds do very, very well in that environment because recessions are deflationary. And so therefore, the 10, the 20, and the 30 will go pretty nicely in those, and they have in the past.
All right, Pete Batten, great to have you. Thanks so much. Still ahead, the Fed raising rates by 25 basis points. Find out what it means for President Biden's fight against inflation. We'll be right back.
The Fed's 25 basis point hike is what the markets were hoping for, but what does it mean for President Biden's agenda? Yahoo Finance senior columnist Rick Newman is here with that. Rick, good to see you, sir. Should President Biden be celebrating this or not so much?
I don't know why he'd be celebrating, but we got a big sell-off because his Treasury Secretary said a few unpopular words in front of Congress. It kind of feels like nobody can do anything right at the moment, doesn't it? So the Fed moderates, it goes a bit dovish, and people don't think it's dovish enough. So Jerome Powell's getting criticism because he doesn't seem to be caring enough about banking stability. Then you have the Treasury Secretary, Biden's appointee, Janet Yellen. She refuses to say that the Biden administration is considering insuring bank deposits to infinity, and that sends stocks down. And meanwhile, inflation is still 6%, and First Republic still seems to be on the rocks. So nothing seems to be going Biden's way at the moment. But what Biden really needs is things going his way 6 or 8 months from now, assuming that he is going to be running for re-election. And what he really wants to see is some momentum at the start of 2024. So that gives Biden some running room. But I don't think this is a great day for President Biden.
No, I don't think 0.4 GDP growth is exactly what the president wants as we look forward to an election. But elsewhere, and this does relate to the Fed, Senators Elizabeth Warren and Rick Scott, who are on complete opposite ends of the political spectrum, have actually teamed up on a bill that would require a presidentially appointed and Senate-confirmed inspector general to the Fed board. Now, that is a combination. I would compare it to Hidden Valley Ranch debuting an ice cream or White Claw debuting a vodka. It just doesn't make any sense, but it should be interesting, Rick.
Well, the crazy thing about this is each of these people is kind of at the extreme within their own party. So it's kind of like they went through the back door of a time warp and ended up meeting on the other side somewhere. The crazy thing about this, Dave, is this is not a bad idea, what they're proposing. No. So all they're saying is that instead of the Fed having its own inspector general in-house, that's the investigative arm that looks into what the Fed actually does and would look into, for example, would have a role in figuring out the Fed's role in the failure of Silicon Valley Bank. Why didn't it do more? We're going to find out about more. All they're saying is take that function outside of the Fed, take it outside the House and make it independent, which is the way the Inspector General's office operates at just about every other agency. What that means is that the person in charge of the agency doesn't have any sway over what the Inspector General does. So that's a good thing. So it's almost if you took a lot of acid and a lot of alkaline and you actually got fertile soil from these two polar opposites politically actually getting together and putting this idea forward.
Hey, Scalia and RBG were best friends. So who knows, man? Maybe the best things come of opposites. I applaud it. Rick Newman, good to see you, sir. Thank you.
Hi, guys.
All right, Shauna, what's moving after hours?
All right, Dave, we got two stocks for you here. We have Chewy and KB Homes. Let's get right to it here. Chewy, that stock off just about 2% here in extended trading. A couple of things. Q1 sales guidance missing the street's expectations. Also, the number of customers that Chewy has declining from a year ago, off by about 1%. That also came in just below what the street was expecting. In the shareholder letter here, executives pointing to the fact that we are seeing some softness across the broader economy. That's what they're saying was reflected in the drop that we saw in the number of customers. Also, more broadly speaking, their results here last quarter. Year to date, we're looking at a gain of just about 1.8% over the last year. That stock in the red, off just about 17%, so not as poor of a performer as some of its competitors out there. And we also know Petco was under tremendous amount of pressure today following its results, but Chewy off just about 2.5% here after hours. Flipping over to KB Home, this stock on the move to the upside, up just about 3% in extended trading. A solid report here by the home builder. They beat on both the top and bottom line. Also announcing a new $500 million buyback program. The company saying that it is starting to see demand tick up and it's very important spring buying season, attributing some of that to the quote stabilization that we have seen in mortgage rates. So we'll see whether or not that momentum can continue. Year to date, the stock up just about 15.5%. We have seen a bit of an outperformance here from the sector at large, but over the last year, still looking at shares in the red, off just about 2%, Dave.
Okay, Shauna, thank you. Good stuff. With the potential ban of the popular social media app TikTok on the horizon, the CEO of its Chinese owners, ByteDance, set to testify before the House on Thursday. For more on what we can expect from the Hill and what this all means for the app's estimated 150 million American users, which still blows your mind, doesn't it, Allie? We are joined by Yahoo Finance's Allie Garfinkel. What are we expecting?
Hi, Dave. Great to see you. So I'm expecting some fireworks tomorrow. The standoff between TikTok and Congress has been in the works now for months, even years, and we've reached this place where we're at the fork in the road, the critical impasse, that point of no return. I just look down for my metaphors? Yes, I did. First, we're going to see, though, TikTok CEO Shou Chew, who's going to start by making his case about the importance of the app to people. And he's actually already started talking about this on the platform itself. Take a listen.
Some politicians have started talking about banning TikTok. Now, this could take TikTok away from all 150 million of you. I'll be testifying before Congress later this week to share all that we're doing to protect Americans using the app and deliver on our mission to inspire creativity and to bring joy.
So expect to see Shou continuing to build on that case tomorrow. And to that end, you're going to hear that number, 150 million, a lot tomorrow. That amounts to about 45% of the US population that is on TikTok. I'm anticipating that Chew will be emphasizing that popularity. He'll also be focusing on how it's improved the lives of creators on the platform, and look for him to especially make that small business case. Now, additionally, there was one thing that was really striking to me as I was reading his written testimony today. Chew, it sounds like, is ready to dive headfirst into a lot of lawmakers' concerns, both about data security and about the security of minors on the platform. Now, after Chew finishes his opening remarks, we're going to see lawmakers pretty aggressively questioning him. Those questions are also going to be coming from both sides of the aisle. He's facing something right now that's pretty rare in Congress, a united bipartisan front. These lawmakers are all connected in their concerns about TikTok security, both to users and to the country as a whole. If there's a lawmaker to watch here, it's going to be the committee leaders. Look to especially Republican Cathy McMorris Rodgers. Her aides have told Yahoo Finance that she's going to be on the offensive. Ultimately, how Chew responds to these questions is going to be key to what happens from here. Bottom line, Dave, for TikTok, this is the moment of truth.
It sure is. It's going to be a really interesting watch, in particular his emphasis on the impact on U.S. businesses. I'm curious on the complete flip side of this. Any word out there from analysts or even your own opinion about what the potential impact of a TikTok ban could mean for Meta on the upside?
Well, it would be great news for Meta. The other company it would be great news for is Snap. Snap is known for its popularity among teenagers, and it's known for being something that teenagers have to have. And TikTok is that times 10, times 12, however you want to shake it out. Those numbers aren't exact. That is me speaking in an exaggerated way. But I would say that, yes, there is, of course, possible upside for Meta. There's possible upside for Snap. The real question is how it will affect the creator economy down the line. A lot of creators I've talked to are very devoted to TikTok and say that it's better for their businesses than anything else. So yes, there's some possible upside for Snap. Yes, there's some possible upside for Meta. And I think in the end, we won't know more though until it actually happens. Because the reality, Dave, is that the mechanics of banning TikTok are actually incredibly complicated. And we'll see if they can actually do it.
Yeah, it'd be interesting to talk to these creators and how they could replicate what they're doing on YouTube Shorts or Instagram Reels. We shall see. Look forward to talking to you after this. Allie Garfinkel, thanks so much.
All right, and be sure to tune in. And tomorrow morning, 9 a.m. Eastern Time, Yahoo Finance is going to be covering TikTok CEO Shou Chew's testimony for the House Energy and Commerce Committee. Yahoo Finance's Rochelle Akufo will be reporting live from Capitol Hill. Now, first up in the 9 a.m. Eastern Time hour, Rochelle is going to be speaking with Republican Congressman Jay Obernolte of California. And then in the 3 p.m. hour, she'll be speaking with Punchbowl News congressional reporter Max Cohen. In the 4 p.m. hour, Rochelle is going to be speaking with the Republican Congressman Ken Buck of Colorado's 4th District. We will discuss regulation, what a potential ban could mean for influencers and creators on the platform, and also what companies could potentially stand to benefit if we, in fact, do see a ban of TikTok. We got the coverage for you starting tomorrow, 9 a.m. Eastern Time, right here on Yahoo Finance. All right, well, coming up, we will break down some of the biggest takeaways from today's top stories. Stick with us. It's closing time here at Yahoo Finance. Let's get you caught up on some of the biggest headlines of the day. First up, the Fed's staying on its rate hiking campaign despite the recent volatility in the banking sector. Now, the central bank raising rates by 25 basis points, with Fed Chair Jay Powell reiterating the fact that the fight against inflation is far from over. Those comments ultimately dragging down the major averages here, which ended Wednesday lower, the Dow shedding more than 500 points during the session.
In other news, Nvidia founder and CEO Jensen Huang joined Yahoo Finance to fill us in on his company's AI ambitions. Huang stressing how AI is moving out of the laboratories and into industrial operations, while diving into how the company will incorporate into its cloud services. Huang also showing off Nvidia's DGX supercomputer, which is designed to run generative models for imaging, video, and languages.
And turning to tomorrow, TikTok CEO Shou Chew will be in the crosshairs of the U.S. House Energy and Commerce Committee. Now, the social media platform is facing pressure from the Biden administration over issues of national security. TikTok could face a ban in the U.S. if its parent company ByteDance does not sell its stake in the U.S.'s version of the app. Shou Chew will tell lawmakers in his testimony that banning TikTok in the U.S. is going to hurt American businesses and also the country's economy. Let's get one more look here at the markets before we let you go for the day. Again, all three of the major averages closing in the red. You're looking at the Dow off 530 points, S&P off just about 1.6%. The Nasdaq also in the red. The move lower coming after the Fed raised rates by 25 basis points. Fed Chair Jerome Powell reiterated the fact that inflation remains way too high, and the Fed remains committed to bringing down inflation. But we really saw the pressure in the markets following comments from Treasury Secretary Janet Yellen and some of the comments that she was making while testifying before senators earlier this afternoon, saying that Treasury is not considering or working on a unilateral expansion of deposit insurance. So maybe adding to some of the jitters out there about what exactly could be ahead for the banking sector. But again, a big day of losses across the board.
Interesting. All right, that'll do it for us for Yahoo Finance Live. Be sure to come in tomorrow at 3 p.m. Eastern Time. All your coverage leading up to and after the closing bell. We'll see you tomorrow.